Guys, thanks for coming along tonight. I apologise for my dodgy background. I normally go live through a different or alternate system, but it kept blocking me tonight, and I'm not that technological person. So, all good. So, sorry for my dodgy background, guys. So, tonight I just wanted to talk to everybody about calculating risk individually, because there's many reasons around it. When you're calculating risk, you need to know what your risk tolerance is before you enter or before you do any property investment. And then once you're doing property investment, you need to know what level of risk you can go to as well. So I'm just going to give you some ideas here today of what I do when I'm looking for people in regards to what risk tolerance they may or may not have. So there is some common sense things, but these are my 9 things that I'm going to talk about tonight that I believe are very important when calculating the risk, or for yourself, certainly if you think you're ready to go into an investment property or investment portfolio. So guys, bear with me with my dodgy background. It's putting me off a little bit. Sorry about that. So first one, simple. The first couple are quite basic. It's basically first, number one is your borrowing capacity. So how much will the bank lend you on what income and what debt you already have in place? So your borrowing capacity has nothing to do with your savings. It has, to a certain degree, nothing to do with what equity you have, even though that could limit how much what your borrowing capacity is. But what you're going to need to work out is, I have this much income, the bank will allow this much to pay off loans, and this is the amount of money I can borrow. Obviously, the reason why I want you to do that, so if your borrowing capacity is, say, for example, $700,000, and you go out there tomorrow and buy an investment property for $699,000, you're sort of reaching your limit, and you're sort of entering into a little bit of a risky area, depending on what your asset base is, etc. Sometimes it's okay to do that. For example, if you're going through just a quieter year with your job prospects, or you got a bit less overtime for that year, those sort of things can come into play. But as an overall rule, if you're borrowing to your limit, especially, this is probably more, say, take away property investment altogether. If you're a first home buyer and you're borrowing to your maximum, 2 incomes to pay for that, and if you're young and haven't had kids yet, you're entering into a high risk category for the bank. Even though the bank may give you the money, that's great, but you've got to take that into consideration in how you're going to pay it all back. Okay, so the first one is borrowing capacity. So how much income you have coming into the household compared to what your ongoing repayments, whether that's rent, car loans, credit cards, home loans, whatever, and then they'll assess and give you a borrowing figure. Okay, so the next thing, so number two is, okay, you're going to lend me $700,000. What sort of deposit is that going to be? So it's equity, it's savings, it's all different assets that you can put in place to give the bank as security. Now, depending on the bank, most banks will take a home as security, but you might have a commercial property you want to use as security. So there is limitations with commercial property, or you may have an acreage. So basically, once your property goes over, say, let's be ridiculous, over 100 acres, the bank may not lend you 80% of that value. They might only lend you 60% of that value. So that's another risk scenario. But they're pretty well basic risks. Before you can borrow money, if the bank's going to assess you on those risks anyway, but you really should do your own calculations on that as well. Now, the next one is experience and or education. So education is one thing, and that is obviously watching people like myself, might be attending courses, might be reading books, but then you also have on top of that is experience. So experience in investing. So your partner might have had experience, you not, so that always helps. But a lot of people can go through different phases of life to get the experience. So for example, what I mean by that is the most common one is divorce. You might actually have an investment portfolio, need to sell that investment portfolio because you've got to clear out assets, etc., and then restart your investment again. Now, you as an individual have had good experience with property investment, and you've seen what's gone right, what may have not gone as right. So from that perspective, yes, you've got experience in property investment. So you're not going to be as nervous or hesitant to buy your first property because experience is a big factor. And I see it on a regular basis that your first property, everyone's nervous, worried about vacancy, worried about if they lose their job, etc. But by the time it comes to the second and third property, they don't even care. They just want it to, it's a 100% investment decision, and they just want to see the numbers and the growth prospects, etc., etc. Okay, sorry guys, I've got me a little list here so I don't forget. But okay, the next one up on my list is first-time investors. So this is a good one, actually. This is a question I will ask nearly every single new client that walks in my front door is, what is the biggest mortgage you've ever had? So the most common, I suppose, you'd probably say the 50% of my client base that comes in for the first time as a first-time investor are normally in their 40s, whether it's early 40s, late 40s, potentially 50s. Now, us older people, even if you're 60 even, us older people, when we first bought our property, house prices were quite low. So our mortgages were quite low. Even though interest rates may be higher, our mortgages were quite low. And that can be a really mind-numbing thing to get past. So what I mean by that is, for all the younger people out there, your parents may have lived in the home for 30 plus years. And when they first bought the house, they might have only had a $50,000 or $100,000 mortgage, spent time with the kids, paid it off over 10, 20, 30, 40 years. Sorry, 40 years is a bit ridiculous. So 10 or 20 years. And when they go to buy an investment property, they've got to go into $500,000, $600,000 in debt. Yet their mortgage may have only been $100,000 maximum in the past. So that's another mindset you have to get past. I did have someone in my office last week. Their biggest mortgage was $120,000, and they've owned their home, I believe, for some time. So for them to go back into debt, they've got to do it more on a slower case scenario. Even though they've got to be more assertive, they've got to get one property under their belt, get used to the debt, because debt is not all about the debt. It's also about the cash flow and how it's all paid back. And it can really ruin your mindset when you're going to start investing if you either A, haven't had a mortgage for some time, like a decade or 5 years, or B, the largest mortgage you've had was quite small. And that also comes down to your property prices. If you're, what I normally say to people is that every investment property you put in place, in many cases, is the largest or highest price property or the largest financial decision you've made so far in your life. So for those people who get frustrated because they want to invest but they're just too nervous, you've got to get around that mindset of, sure, the property I bought in this street was $150,000, but you've got to realize down the road now they're selling them for $700,000. So your home's worth $700, they're worth $700. For you to go buy an investment property at $500, there is some perspective there. So you're not paying too much, or you just got to get around the mindset of what the real values are for the properties. Some people in that mindset will go very regional and buy cheap. And now they may or may not regret that through vacancy or through ongoing repairs, but it can make you decide potentially on making a bad decision for investing. So that's for that side of things. And then of course, number 5 is cash flow. So with cash flow, I always like to make sure you've got strong cash flow. So what I mean by that is some signs that I look for, and this is an example of, say, having a mortgage already, is that you may have some redraw in your home loan. You might be paying additional payments in your home loan. You may have an investment account in your some sort of forced saving method to be putting in place. And then, of course, you might just have outright savings, whether it's in an offset account next to your home loan or whether it's outright money you physically saved. Now, sure, the bank looks at that scenario, but you need to have some buffers in place. You need to have buffers. And the reason why I want you to have that is it does happen every now and again where your potential tenant may go away for 2 weeks and outright honestly just forget to pay the rent. Now that doesn't happen that often anymore due to basically there's a lot of less cash transactions, but in that case, you want to make sure you're covered. So you always got to have a buffer in place. And cash management's a big thing when you're buying an investment property. All right, number 6. So number 6 is a good question. What I'm asking everybody is past risk tolerance. So what I mean by that is, what have you gone through in your life financially that has either potentially lifted your risk tolerance or even lowered your risk tolerance? So what I mean by that is, say, for example, when I meet self-employed people, they may have a business just by themselves, or they may have a business with 5 staff or 20 staff. They are going to be open to a lot more risk because they're seeing risk on a day-to-day basis in their business. And so, like for me personally, risk tolerance for myself and say my neighbor could be, I might be on a scale of 10 and they might be on a scale of 2. But I'm used to risk through business and property. So I'm not going to lose sleep over small things, where my neighbor may lose sleep over small things because they've never dealt with that risk before, whether it's business. I had something else down here. Oh yeah, you might have a cushy job. You might have a slow, cushy job. And in that scenario, your risk tolerance is quite low. So you've got to be aware of all that before you start investing, guys. So that's with your risk tolerance side of things. The next thing is you've got to take into consideration when calculating your risk is potentially your job certainty. Now, everybody knows you can be made redundant tomorrow. Your payouts are not like they used to be. So job certainty to a certain degree isn't really there for anyone. I don't care who you work for. But I look at a few things. I've got a few things listed here. So we've got holidays accrued. So I'm a big one to say, try and have 4 weeks holidays up your sleeve as a minimum. I know everyone loves holidays, but try and have 4 weeks up your sleeve so that if you have an investment portfolio and you become unwell, you can take holiday leave or annual leave in, so your pay doesn't drop. That doesn't help you guys out there that are working overtime or getting penalties such as nurses or police officers, etc., or coal miners, etc. That doesn't help you in that scenario, but you'll at least have some income coming in. And of course, you've got sick days. I see so many people who don't take sick days, and that's perfect if you're going to invest. Because if you do get sick, of course, you've got your sick days backed up. Long service leave, a lot of people will bank long service leave. And depending on what industry you're in, you can get some long service leave kicks in from year 5, some from year 10, obviously. And of course, the longer you are, the more long service leave you're going to have in place. So long service leave to me is a little bit like income protection. If you've got long service, you've got good income protection there for, normally I think it's 3 months. I should know that answer, but I don't get it because I'm self-employed. Flexibility from working from home or hours, that is also good as well with job certainty. I do like that as well, because worst case scenario, if something pops up, you can deal with it straight away rather than letting it fester. And of course, available overtime. So what I mean by that is you may work 4 days a week. I have a lot of clients that only work a 4-day week roster, but they can always whack on a 5th day or a 6th day. And the reason why I'm mentioning that is I don't want you to work overtime just to have an investment portfolio. I want the overtime availability just in case your partner loses their job for a short period. So that's another way of assessing whether you're entering into too much risk or you're comfortable in risk as well. That's a big one for me as well. So, and now I'm just going to give you 2 examples of higher risk. So the first one is, I'm sorry guys, just got to read off this because my Zoom's not working. You may want to build a triplex, for example. So for those of you who don't know a triplex, a duplex, as everybody knows, is 2 properties side by side in most cases, where a triplex is like 3 properties on the one block of land, and you might subdivide and sell them off, or whatever you want to do. You could keep them as well. But with that triplex, they might be a 12 to 15 month build process. And in that process, you could have a worst case scenario of earning, say, $50,000 in equity uplift or potential capital profit, or you might be able to get $200,000 in equity uplift for a good scenario. So that would be your range. You've got a $150,000 range, worst scenario, good scenario. But then what if something goes wrong? And what I mean by that is council doesn't approve the triplex. the neighbors complain, some tree frog, endangered tree frog is found on your property. It could be a certain plant is found on your property. And I'm not talking about marijuana, of course. And for that, you might actually not be able to build that triplex. So for you to exit that property, because the worst thing you can do is keep the property if it's not going to work. Get out of it, take a loss, and move on. It's like with share traders, they have, I think it's called a stop loss, and it might be 2% or 5%. And I'm pretty sure, I'm not a huge trader, so I'm pretty sure you can set that if your share value drops 5%, it automatically sells your share for you. Now, I really wish a lot of investors out there thought that same process, because what they do is they hang on to that thinking it's going to make money for them long term. I'm a big one is I would exit, take a loss, but to be ready for that risk tolerance, you need to have a backup plan. So, and that is not your home, it's not your home mortgage, it's not your savings, or your personal savings. So before we could do next level investing, we always tell our clients to build that foundation for your portfolio. Because if you've got 2 or 3 properties, you might have a 20, 30 grand buffer in your bank account. If you make a loss of $50,000 on this suggested triplex, you need to be able to be in a position that that's not going to slow you down for 12 months, 3 years, 5 years. You want to make sure you can take that $50,000, borrow it potentially against the equity of one of your investment properties, not your own home. And what you're in that position there is you can just keep moving and you'll learn from those failures or mistakes or what you could have done different. All the successful people in the world talk about they didn't become successful overnight. They failed many, many times before they got it to work. I have failed a couple of times. That's why I'm here. And I give advice on property because I know what you can do and what you shouldn't do, what normally works and what potentially might not work. So you want to make sure you have that surplus equity or potential investment cash flow that you can get that shortfall paid and just get out of that investment structure and move on to the next one. But that's all about, from my perspective, what I like about that is when you're at that next level stage, you got to have that foundation set. Otherwise you can come out ass first. And the next one is a joint venture. So the reason why I'm bringing in joint venture is, as far as a risk or calculating the risk with a joint venture, just say, for example, it's a 50-50 joint venture. And what I mean by that is you may not put 50-50 of cash in, but you're both going to share the profit 50-50 on the way back out. But at the end of the day, you're both taking on the risk. So you're actually sharing the risk. In that scenario, I love joint ventures. I think joint ventures are a great way to do your first, what we call next level or elite property investment strategy, where you may do a buy and sell strategy to make some profit. You'll make less, of course, but doing it as a joint venture, you've got 2 heads are better than 1 in most cases, and you're sharing the risk. So if you do come out, I don't know, worst case $50,000 loss, you're in a position where it's only 25 yourself and 25 for your joint venture partner. Now, joint ventures consist of many different strategies. It could be they're giving you the deposit and you've got the income to service the debt. They could be servicing the debt on your behalf. They could be the brain trust. They could be the brains of the whole thing. You found the property but don't know what to do with it. That's a common one, where you find the site but you don't know how to put it together. You do a joint venture with someone who does, and that can also give you a good outcome as well, because that experience, whether you make 10,000 or 100,000, is worth millions for you down the track. And of course, the experienced partner is the best way to go with that joint venture structure. Sorry guys, that's what I got for tonight. I really apologize for the disjointed start tonight. I'm not sure. There's been an upgrade somewhere with the Zoom platform and it didn't let me link it to Facebook. But guys, I appreciate you tonight. I'm sorry I can't see comments. I'm not sure if there's any comments in place. But guys, thanks again for listening tonight. We'll come back to you next week a little bit more prepared for this update. Next week, I'm going to talk about what I think a good blueprint to work off for a successful portfolio, okay? So what I mean by that is how I sort of see a portfolio when I'm visualizing for a new client or an existing client, how I visualize what can work for them. Of course, the portfolio I want to discuss is just a generic portfolio, But if everyone did the generic one, they would still work quite well for themselves. But of course, depending on your risk tolerance is what level you'll end up going. Guys, thanks for watching tonight. Jess is going to pop into the comments the 15-minute link. So what that is, for those of you for your first time watching tonight, whether you're watching it tonight or watching it through the week after, it's a 15-minute link where you can book it in, touch base with me. It gets booked straight into a call with me in my calendar, and I'll give you a call for 15 minutes to have a quick chat about what you can and can't do, guys. Mate, I'm Wayne Jessup, the property bloke, bringing real property and real strategies to get real results for everyday Australians. Thanks again, and I look forward to chatting to you soon.